Hi, and welcome to Chapter 4, the accounting cycle, continued. Okay, so we're on to the next part of the accounting cycle, the adjusting journal entries. So learning objective 4.1, explain adjustments and how to record them on a worksheet. So pay attention to this. It can be a little confusing to some students. Okay, so parts of the manual accounting cycle. We have business transactions. Something happened. We purchased something. We sold something. We paid rent. Then we go on to booking it in our journal entry, which is commonly referred to as the book of original entry. Then we post it to the ledger. After posting the journal entries to the ledger, then we create a trial balance, a nice little worksheet to find out, if we're debits and credits, we're in balance and everything like that. And then from the trial balance, we do this worksheet. Now in computerized system, this worksheet kind of completes itself, but in a manual one, we are using the worksheet. Now you still need to do an adjusting journal entries in an automated accounting system generally. But the financial statements, you might press a button and an income statement and a balance sheet pop out. But we, at this point in our accounting careers, need to learn how to prepare everything manually. So from the trial balance, number 4, we come down and create the worksheet. Okay, the worksheet has 5 main columns: a trial balance, adjustments, adjusted trial balance, and then the income statement and the balance sheet. So then from that, you can produce your formal financial statements, your income statement, your statement of owner's equity, and your balance sheet. But the worksheet is just kind of like an extended trial balance that makes sure everything is in line and everything looks cool. Okay, so step 5 of the accounting cycle is preparing a worksheet. So it's used to organize and check data, used to find and correct errors before financial statements are prepared, thought of as scrap paper. So it's not a formal financial statement because it does have debits and credits on it. It contains columns for trial balance, adjustments, adjusted trial balance, income statement, and balance sheet. So it can be a little confusing at times, but in the end, I think it's helpful once you fully understand it. Okay, so here is an example 4 of the 5 columns. I mean, it's really 10 columns if you think about it, because each column has a debit and a credit column. So you listed your account titles here are in the same order of your financial statements or your assets, your liabilities, your capital accounts, your revenues, your expenses. So it needs to be, it's listed in that same order you have to do your trial balance, and they're in order of liquidity as well. So cash is always your most liquid asset. So this is the trial balance, just repeated from the trial balance itself. Okay, then we need to do adjusting entries. So these are internal transactions, so they don't occur outside of the business. They don't involve cash coming in or out of the business. In fact, adjusting entries never involve cash. Okay, they bring accounts up to date. They recognize revenues and expenses in the proper accounting period. So you always want your revenues, any revenue you're making, you want the expenses associated with those revenues recognized in the same period. So for example, in the month of December, if you make $10,000 of revenues and you do have salaries expense at the end of December, let's say the last 4 days in December, you have some salaries expense, but it does, because you only cut checks every 2 weeks, it's not going to get paid till January. But you want those expenses of those salaries lined up with those revenues. So this is just making sure your revenues and expenses are recorded in the proper accounting period, whether it be in December or in January. Okay, so the items that need to be adjusted are computer supplies, prepaid items like rent and advertising, equipment, so depreciation, accumulated depreciation, and expenses, so salaries, rent, and supplies. So how do we analyze and adjust the accounts? So the first one we're going to do is supplies, so computer supplies account. Purchase of supplies, $600. Okay, so if we, at the beginning of our accounting period, purchased $600 of supplies, that will go on our balance sheet, right? And then at the end of the period, we see our inventory of supplies is only $100 because we've used up $500 worth of supplies. So now it's no longer an asset because we've used up, if that's 10 cases of paper, or probably more than that, but if it's binders, if it's maybe ink for the printers, but you have that supplies used up, so now that supplies of $500 becomes an expense. So you want to get it off of your balance sheet, and it's an expense. You have to recognize it as an expense. So you have your computer supplies account, and you're reducing your computer supplies account by $500, and you're recognizing $500 of expense. So you're going to debit expense and credit computer supplies account, so that your ending balance in that computer supplies accounts is $100, because that's how much supplies are left in the supply cabinet. Okay, so in the adjustment column then, you would record that adjustment journal entry. Again, we are debiting computer supplies expense for the $500 and crediting computer supplies. This, we're going to refer to it as transaction A, just so that you can match your debits and your credits here if you need to see if you made an accounting error or something. Computer supplies account, computer supplies expense was not on our original trial balance, so any accounts that aren't on our original trial balance, as we do adjusting entries, we just add them down here at the bottom. Okay, so it was a decrease in computer supplies, $500, so we credit it. It was an asset, we're reducing it, so we credit it. An increase in computer supplies, we debit it, we increase it. Okay, so how do we analyze and adjust accounts? So number 2, prepaid rent. So we had prepaid rent 3 months in advance, $1,200. So on our balance sheet, we would have had prepaid rent of $1,200. Well, now 1 month has passed. So we have to recognize what amount of rent has been used up, $400. So rent becomes an expense. So we are debiting rent expense, $400, and crediting prepaid rent, $400, so that $800 is left on our balance sheet. So again, we go to the trial balance. We debit rent expense. Again, we have to add a line down on the bottom here because it wasn't on our original trial balance. It's referred to as transaction B, so we're debiting $400, and we're crediting our asset. So we're reducing our prepaid rent by $400, so we credit it. Okay, computer equipment. So computer equipment depreciates. If you have maybe a vehicle or something that you own for your business, that depreciates. If you have a building, that depreciates. So it's expected to help produce revenue. Equipment is allocated over its useful life. So in order to calculate depreciation, look at the cost of the equipment minus the residual value divided by the estimated years of usefulness is your depreciation per year. So this, I think in all cases, it just gives you the depreciation. You won't need to calculate this formula unless you go on to financial accounting. Then you do need to calculate. You will be calculating depreciation per year. Okay, so our answer is 960 depreciation per year. Here's a table of how companies generally estimate useful lives. The formula on the previous page was straight line depreciation. There's other methods of depreciation that you will learn more detail about in financial accounting. So furniture, generally the estimated useful life for furniture is 3 to 25 years. Building 10 to 50, office equipment 3 to 15. Building maybe 40 years for equipment, 3 to 15 years, or for a building it would be 40 years for equipment, maybe 3 to 15 years. And there, like for Dollar General, the building is 39 to 40 years and furniture 3 to 10 years. Okay, so you don't need to know these estimated lives. These are just examples for your information. So it's just kind of interesting how long everything depreciates. But generally, you will be given, I mean, even in financial accounting, you'll be given the useful life of the equipment to figure that out. Okay, so keep a running total of depreciation taken, called accumulated depreciation. So on the balance sheet, we have our fixed assets. We have our computer equipment, $6,000. So that was the original cost, the historical cost of what we bought that equipment for. So we leave that on the balance sheet, and then we use this account, which is a contra asset account, accumulated depreciation. And a contra asset account means that its normal balance is a credit. So remember, an asset, the normal balance is a debit. But for a contra asset account, the normal balance of the account is a credit. So that's why we're subtracting the accumulated depreciation to get our net computer equipment there. So that is how it's presented on the balance sheet. Okay, so we had 900, we had calculated back on a couple, maybe 3 previous slides. 960 per year was our depreciation, but we're going to do the journal entry just for 1 month at a time. So every month we would have to do this journal entry. So depreciation becomes an expense. We debit depreciation expense. We credit accumulated depreciation. Remember, this is a contra asset account. So to increase it, we credit it. Okay, so then we have transaction C, and we add these both at the bottom since those accounts have not been in our trial balance previously. We debit depreciation expense, and we credit accumulated depreciation. And like I said, if you had different fixed assets, like maybe you had office furniture, then you would have depreciation expense, office furniture, accumulated depreciation, office furniture. And they, if you had a computer equipment and then you had office furniture, it would just be added to the bottom here. Okay, so our next adjusting entry is salaries accrued account. John worked May 28th, 29th, 30th, 31st. This 350 is an expense in May. So this is like the situation I spoke of before. So we have to recognize the expense for those days that he worked in May, although he's not going to get paid until June because they only pay every 2 weeks. So those 4 days actually get paid, but we have to recognize the expense. So that's why we are debiting office salaries expense $350, and we are crediting salaries payable because this is an amount due to John in the month of June. So we, again, we do have office salaries expense up here in our trial balance, so we debit that $350 and we credit salaries payable. Okay, so salaries payable is a liability. To increase the liability, you credit it. The expense, to increase an expense, we debit it. Okay, so I'm going to go back. The next thing you would do is total these accounts and put a grand total here and make sure your debits and your credits balance. But that is probably covered in the next learning objective when we continue with the worksheet. See you then.